Warren Buffett just posted a 48% gain. His biggest win in years, and the first thing he does? Tell shareholders not to celebrate. Quote, "Our progress was not as good as it looks." While every other CEO was inflating their numbers, Buffett was deflating his. Why? Because he saw something coming. Something that would destroy 90% of investors who trusted the scoreboard. Drop a comment right now. What's your biggest challenge reading financial statements? Picture Wall Street in 1998. The dot-com bubble is inflating. The S&P just gained 29%. Tech stocks are going vertical. And every CFO in America has discovered a magic trick. They've learned how to make earnings appear out of thin air. Stock options, not an expense. Restructuring charges, ignore them. Merger accounting, a goldmine for manipulation. Meanwhile, Buffett's reading Berkshire's annual numbers and he's worried. His book value jumped 48.3%. On paper, it's spectacular. The media will love it. Shareholders will cheer, but he knows the truth. Most of that gain came from accounting magic, not economic reality. He issued Berkshire stock, trading at a premium, to buy General Re. The math made his book value soar, but his actual intrinsic value grew much less. Here's what most investors do. They see headline numbers. Earnings per share up 20%. Book value up 48%. Stock price climbing. And they think, quote, "This company is killing it. I should buy more." They're reading propaganda and mistaking it for intelligence. It's like a soldier on the battlefield trusting enemy radio broadcasts about troop positions. The numbers sound good. The presentation is professional. But behind the scenes, companies are playing games. Hiding costs, manipulating charges, creating earnings that don't exist. But Buffett sees through the fog. He knows that what accountants count and what actually matters are two different things. He stated it directly in his 1998 letter. It's the per-share gain intrinsic value that counts rather than the per-share gain in book value. 1998. He's about to teach shareholders a three-part reconnaissance system, a way to get behind enemy lines, to see what companies are really worth, to separate economic fact from accounting fiction. And he's going to do it by confessing his own mistakes, exposing corporate fraud, and using the greatest golf analogy in financial history. Before you trust any financial statement, you must first separate accounting optics from economic reality. What the scoreboard shows is often propaganda. What the business actually earned is intelligence. Learn to decode the difference. Here's where retail investors get slaughtered. They see Berkshire's book value up 48%, and they think Buffett just had his best year ever. They see a company report record earnings and assume record value creation. They compare price-to-book ratios and think they're being analytical, but they're reading propaganda disguised as facts. Why does this happen? Because accounting lets companies create value on paper without creating value in reality. When Berkshire issued stock at 2 times book value to buy General Re, the math automatically boosted per-share book value. Did Berkshire shareholders get richer? Not really. The economics were roughly neutral. But the accounting made it look spectacular. You see the number go up, you feel smart. You think, quote, "I own a piece of a company growing 50% a year." But you're counting accounting entries, not economic gains. The amateur sees a 48% gain. The professional knows it's closer to 15%. That gap? That's where fortunes are lost. The professional does something radical. They ignore the accounting and calculate intrinsic value themselves. Buffett developed a strict discipline. When Berkshire acquires a company, he asks, "What did we give up in economic value? What did we receive in economic value?" If these are roughly equal, the deal is neutral, no matter what the accounting shows. This requires brutal honesty. In that same 1998 letter, while his book value was up 48%, Buffett told shareholders his intrinsic value grew far less. He could have stayed quiet. He could have basked in the glory. Instead, he taught them to think correctly. Think of it this way. In military intelligence, propaganda tells you the enemy is weak. Real reconnaissance shows their actual strength. The soldier who believes propaganda gets ambushed. The general who demands verification survives. Buffett demands verification of every number. He will not let accounting fiction dictate his view of reality. Let me show you this principle in action. In 1998, Buffett was managing $57.4 billion, the largest net worth of any American corporation. He'd compounded at 24.7% annually for 34 years. Legendary performance. But here's what he told shareholders. Quote, "Our future rates of gain will fall far short of those achieved in the past. Berkshire's capital base is now simply too large to allow us to earn truly outsized returns." He set expectations at 15% annual growth going forward. Then he explained what that meant in real dollars. Quote, "It means we will need to increase net worth by $58 billion. Think about that, not 58%. 58 billion actual dollars of new value. That's more than most companies will ever be worth in their entire existence." He wasn't hiding behind percentages that look good but mean nothing. He was showing economic reality. The reconnaissance officer giving accurate intelligence, not optimistic propaganda. And the result? Shareholders who stayed with him understood what they owned. They weren't surprised by slower growth. They were prepared. They had truth, not fiction. But understanding that accounting and economics diverge is just the first rule. Because even when you know to look past the numbers, companies have learned to hide their biggest costs completely. Costs that don't appear anywhere in the financial statements. That's where Reconnaissance Rule 2 comes in. Every expense should reduce earnings. But through an accounting loophole, companies hide billions in compensation costs by paying employees in stock options instead of cash. These invisible expenses destroy shareholder value while making earnings look spectacular. Here's how investors get fooled. They compare two tech companies. Company A reports earnings of $5 per share. Company B reports earnings of $5 per share. Same price-to-earnings ratio. They look identical. So you buy Company B because it's in a hotter sector. But here's what you missed. Company A paid employees in cash. That $5 is real. Company B paid employees in stock options worth $3 per share. That cost? Completely excluded from earnings. Real earnings, $2. You thought you were buying a stock at 20 times earnings. You're actually buying it at 50 times earnings. The amateur sees matching numbers and assumes matching economics, but one company is hiding massive costs. The accounting makes them invisible, and by the time you figure it out, you've been diluted by 30%. Your ownership stake shrank and it never showed up in the income statement. The professional treats all compensation as an expense, regardless of how it's paid. Buffett explained this with devastating simplicity in his 1998 letter. He said, "Think for a moment of that $190 million we are going to spend for advertising at Geico this year. Suppose that instead of paying cash for our ads, we paid the media in 10-year at the market Berkshire options. Would anyone then care to argue that Berkshire had not borne a cost for advertising? Of course not. The form of payment doesn't change the economic reality. You gave away value. That's an expense. Period. So Buffett does something radical. When evaluating any company, he calculates what those options could have been sold for publicly. Then he subtracts that amount from reported earnings. His adjustment, quote, frequently cut the reported per-share figures by 5%, with 10% not all that uncommon. That's the real earnings. That's what the professional uses for valuation. In 1998, this wasn't just theory. Buffett was completing the General Re acquisition. General Re had a stock option plan. Buffett killed it immediately and replaced it with a cash compensation plan tied to operating performance. The two plans had matching economics, same cost to Berkshire. Same potential payout to employees. But there was one difference. The cash plan would show $63 million in annual expenses on the income statement. The option plan would show zero. Let that sink in. $63 million in real costs. Invisible under GAAP accounting. Multiply that across corporate America, and you get the scale of deception. In late 1998, companies were using options like confetti. Tech firms especially. They'd report spectacular earnings growth while diluting shareholders by 10, 15, 20% annually. Buffett fought this publicly. He asked 3 questions in his letter. If options aren't a form of compensation, what are they? If compensation isn't an expense, what is it? And if expenses shouldn't go into the calculation of earnings, where in the world should they go? Nobody could answer. Because the practice was indefensible. It was accounting fraud, blessed by auditors, protected by CEOs, and enabled by Congress. But Buffett saw through it. He always calculated real earnings. And that discipline saved Berkshire shareholders billions, but even stock option manipulation pales compared to the third tactic. This one is so brazen, so systematic, that Buffett compared it to cheating at golf. And when you understand how it works, you'll never look at earnings reports the same way again. Companies manipulate earnings by dumping multiple years of costs into one terrible quarter, calling it a restructuring charge, then reporting artificially clean earnings forever after. It's systematic fraud, enabled by accounting rules, blessed by auditors, and ignored by Wall Street. Here's what happens to unsuspecting investors. They own a company trading at $40 a share. One quarter, the company announces a massive restructuring charge. Earnings per share come in at -$5. The stock drops to $35. Management says, quote, "We're repositioning for future growth. This is a one-time charge." Next quarter, they beat expectations by 5 cents. Then again. And again, the stock recovers to $45. Analysts love the consistency. The company never misses. You think, quote, "Management executed the turnaround perfectly. This is a well-run business." But here's what really happened. That restructuring charge wasn't one time, it was a reserve. A cookie jar. And every quarter, when actual costs come in, they charge them to that reserve instead of current earnings. They're not beating expectations. They're cheating at accounting. The amateur sees consistent earnings and buys more. The professional sees serial charges and runs away. The professional watches for serial restructuring charges like a hawk. Buffett exposed this scam with the greatest analogy in financial history. He said companies using restructuring charges are like golfers manipulating scorecards. First round of the season, ignore your actual performance. Turn in a scorecard showing 140. Tell your pro you're restructuring your swing. Next. 4 rounds, count your good holes. Charge your bad holes to the reserve you established. Turn in 4 cards showing 80. Quote, "On Wall Street, they will ignore the 140, which after all came from a discontinued swing, and will classify our hero as an 80 shooter, and one who never disappoints. It's cheating, pure and simple." But companies do it. Constantly. The professional's approach? When you see a large restructuring charge, assume management is setting up future manipulation. When you see serial charges, know they're cheating systematically. And when adjusted earnings exclude these one-time charges that happen every year, walk away. In 1998, an organization called RG Associates tracked special charges across corporate America. They found 1,369 charges that year. Total amount? $72.1 billion. For perspective, the entire Fortune 500 earned $324 billion in 1997. So corporate America took charges equal to 22% of the previous year's total earnings. And they called them all one-time, non-recurring, extraordinary. Buffett told a story in that letter, two bank CEOs discussing a merger. One asks about the huge charge they'll have to take. The other CEO, a serial acquirer, doesn't hesitate. Quote, "We'll make it bigger than that. That's why we're doing the deal." Read that again. They're doing the deal specifically to create a massive charge, because that charge becomes a reserve they can use to manipulate future earnings. At Berkshire, Buffett did the opposite. Quote, "In all of our acquisitions, we have left the loss reserve figures exactly as we found them. No manipulation. Number games, just honest accounting. That's military intelligence versus propaganda. And it's why Berkshire shareholders can trust the numbers. Let's bring this together." Buffett's genius in 1998 wasn't any single insight. It was the complete system. A discipline for seeing through the fog of accounting manipulation to economic truth. The three-part reconnaissance protocol starts with separating accounting from economics. When you see book value up 48%, you ask, how much intrinsic value was actually created? When you see earnings per share up 20%, you ask, are these real economic gains or accounting optics? It moves to uncovering hidden costs. When you evaluate any company, you add back stock-based compensation. You calculate what those options would cost if sold publicly. You reduce reported earnings by that amount. You refuse to pretend that compensation magically isn't an expense, just paid in stock, instead of cash. And it culminates in spotting serial manipulation. When you see large restructuring charges, you mark the company as suspicious. When you see them quarter after quarter, year after year, you know they're playing golf with the scorecard. You ignore their adjusted earnings. You calculate real earnings yourself. And often, you walk away. This is the methodology that separates the 10% who win from the 90% who lose. The 90% read propaganda. They trust the numbers on the financial statements. They believe management when they say charges are one time. They think accounting and economics are the same thing. The 10% demand reconnaissance. They get behind enemy lines. They verify every number independently. They know that companies lie, auditors enable, and Wall Street ignores. So they do the work themselves. Now let me be direct. This system will not make investing easy. Buffett wrote in that letter, there are really only three kinds of people in the world. Those who can count and those who can't, if you can count. If you can see through manipulation, if you can demand economic truth over accounting fiction, you have an edge that 90% of investors will never develop. But only if you use it. Most won't, will you? So here's what I want you to do today. Find the last company you researched. Pull up their financial statements. And ask yourself three questions. First, how much of their book value growth came from real economic value creation versus accounting entries? Can you separate the two? Second, how much stock-based compensation did they issue last year? What percentage of reported earnings does that represent? If you exclude it, are they actually profitable? Third, how many times in the last 5 years have they taken restructuring charges, integration costs, or transformation expenses? Are these truly one-time, or is this a pattern? These aren't comfortable questions, and the answers will disqualify a lot of companies you might otherwise buy. But that's the point. Buffett didn't build Berkshire by buying what looked good on the surface. He built it by doing reconnaissance, by demanding truth, by walking away from 99 deals to find the one that was real. If you want to master Buffett's complete approach to reading financial statements and separating accounting fiction from economic reality, you need to read every one of his shareholder letters from Berkshire Hathaway. They're free on the Berkshire website. No marketing hype. No selling. Just 30+ years of the best investor in history teaching you to think. And for understanding accounting manipulation specifically, the 1998 letter is essential. Link in the description. If this changed how you evaluate financial statements, destroy that like button. Subscribe for more deep dives into how legendary investors separate signal from noise. And comment below, which of these 3 reconnaissance rules shocked you most? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Buffett's strategies require careful study, disciplined analysis, and independent verification. Always do your own research and never invest more than you can afford to lose.